YouTube, what it do to Down Home News TV? I am Dre. I've been slacking, people. I've been slacking. Like I said in the previous video, my son was in town, so I had to take some time off, and it's been rough getting back in the groove. What's that movie? I still got a groove back. How Dre got his groove back. Gotta get my groove back, man. Let's get into it. Got an article coming from Bloomberg, and I know the current president was talking about the robust economy and how many jobs they've created. And sometimes I wonder, are they including the jobs that was shut down from COVID in their estimation of new jobs? Oh, excuse me, my nose. Cut the grass the other day and ooh, sinuses. But this article is coming from Bloomberg. Title is Fed confronts up to millions of U.S. jobs vanishing in revision. Bloomberg, U.S. jobs growth in the year through March was likely far less robust than initially estimated, which risks fueling concerns that the Federal Reserve is falling further behind the curve to lower interest rates. Goldman Sachs Group Incorporated and Wells Fargo's and Company economists expect the government's preliminary benchmark revisions on Wednesday to show payrolls growth in a year through March was at least 600,000 weaker than currently estimated, about 50,000 a month. While JP Morgan Chase and Co. forecasters see a decline of about 360,000, Goldman Sachs indicates it could be as large as 1 million. There are a number of caveats in the preliminary figure, but downward revision to employment of more than 501,000 would be the largest in 15 years and suggests the labor market has been cooling for longer, and perhaps more so than originally thought. The final numbers are due early next year. Such figures also have the potential of shaping the tone of Fed Chair Jerome Powell's speech at week's end in Jackson Hole, Wyoming. Investors are trying to gain insight as to when and how much the central bank will start lowering interest rates as inflation and the job market cools. A large negative revision would indicate that the strength of hiring was already fading before this past April. Wells Fargo economists Sarah House and Aubrey Wolsner said in a note last week that would make risks to full employment of the Fed's dual mandate more salient amid widespread softening in the other labor market data. Once a year, the BLS benchmarks the March payrolls level to a more accurate, but less timely data source called the Quarterly Census of Employment and Wages, which is based on state employment insurance tax records and covers nearly all U.S. jobs. The release of the latest QCEW report in June already hinted a weaker payroll gain last year. Former President Donald Trump called attention to the upcoming revisions at a campaign rally in Howell, Michigan on Tuesday, noting that the job gains in a year through March may turn out to have been much weaker than the government data initially showed. Let's see what they're talking about in this video real quick.
Has definitely shifted. It's gone from inflation to growth concerns. But how pervasive are the growth concerns versus the decades-high inflation that we saw over the past 18 months to two years?
Well, I think it's amazing to think about where we came from, right? If we had been on here 2.5 weeks ago, intra-meeting cuts, right? I mean, 75, like the market got a little ahead of itself. And why? Because we know the inflation story is, right, the Fed had inflation up at 8 or 9. They were behind the curve. They got the story back. We don't want to wait for a full-blown recession to start to ease. All the Fed needs to do is remind people they will still fight inflation. A 5% or a 4.75% 4% Fed funds rate is still high enough to be restrictive to fight inflation, but to give a nod that growth is also slowing. That's what the narrative has to change to. Maybe at Jackson Hole, but it's sometime in the next few weeks.
So the narrative is set right now because the market, I shouldn't say that. The financial markets and traders who dabble in interest futures, that narrative being that it's 100+%, it's a certainty of a rate cut coming up next month. And we could see a campaign of rate cuts through the balance of even next year. It's a trend, perhaps. That's what the market is pricing in. Do you think the Fed has to do anything different with its story at Jackson Hole to either change that or temper expectations?
I get the feeling they'd like to temper expectations because what the market is saying is this is the beginning of a multi-month, year-long easing cycle.
Uh-oh. Sorry for that, people.
I'm not sure that's right. I think this is a calibration, and the bond market has a different message than the stock market, right? The stock market says go, and the bond market says no, right? It says, well, maybe recession risk is a lot higher than I think. The 10-year note at 385, I don't get it. I wouldn't buy it there. So I think the Fed will continue to push back because every time the door opens for easing, the market takes it too far.
Well, okay, so the bond market and stock market are differing in terms of the way they're interpreting the overall macro narrative. Somebody's got it right and somebody doesn't have it as much right. On the equity side, we've talked a lot about the bonds. On the equity side, what exactly does it then look like and what does it bode well for? Are we all going right back into mega cap technology, media, and telecom?
Well, the resiliency is amazing. I would not have predicted us being so much closer to the high, so close to the highs again. But you're seeing some different leadership, right? You're seeing some strength in things that where consumers spend. Not everywhere, right? There's no doubt there's weakness in low-end consumer, and you can see it in the prices. But you're seeing energy. You're seeing some commodity markets move. We've already seen the move in utilities. Banks have done well, right? So it's harder and harder to find cheap things. But it's not just the Mag 7. So I think resiliency and leadership shifting around is a good sign for the Fed calibrating and the economy actually doing better as opposed to a full-blown recession.
Since the market lows that we saw during the washout a couple weeks ago, plus now on that Monday, it has been an interesting leadership role that certain parts of the market have played. Utilities, one of them. I don't know if many traders view that as a positive thing. You can call it broadening out all you want, but when people flock to utilities as leadership, it doesn't necessarily scream, hey, it's a bull market ahead.
No, and we saw it months ago this started, and everyone thought it was the sign of the top, and we continued to do well. So I think, again, the markets are changing, they're adjusting, they like yield, they like stability. And listen, you have to find somewhere to go when the index has been being driven by only a few stocks. Another reason I like commodities is because they're such a small part of the indices now, so investors don't own them. If we're going to have growth, I think that oil and copper and things like that will do well. And so, yes, I think it is strange that utilities fall in that group. It would not have been a prediction, but listen, so far this year they've done well, and so is the market.
At the same time, you mentioned the energy trade, oil specifically. It's not exactly been reacting the way that we thought it would, given geopolitical tensions and concerns about everything else going on in the economy globally. But is energy a value trade that is attractive right now, given the underperformance we've seen from those stocks?
I think it is, if you believe the Fed does the right thing, that this is more of a mid-cycle slowdown, that the Fed can calibrate rates, that on the other side of that, we have questions about inflation. It's not today's story, but do we think inflation is going back to a 1 to 2% range? I personally don't, right? I think there is a lot of inflation pressure. I think that there's plenty of global growth to go around, and that should bode well for those energy stocks as time goes on. So I do continue to like the energy play.
From a base case scenario, you can't construct a one-size-fits-all portfolio, especially not at Morgan Stanley. But if you had a base case scenario, how exactly does the allocation look now, given that kind of state of play that you just laid out?
Yeah, listen, I think you have to have still a significant allocation to equity. And if you're going to own the indices, then you have growth in there naturally, right? I do think you have to think about international and emerging market equity, where you've seen a lot, continued years and decade of struggle. But if you get the dollar weaker, like it's been the last few weeks, and the Fed eases, you get a little bit of love there. And in the bond market, I think what you want is you want to own shorter duration things that carry. Listen, how resilient has credit been? I think the credit story is amazing. It might be boring because we're tired of it, but I would continue to own credit over government bonds, and I would continue to fade away from duration. I would get my duration from the equity market, and I would take my yield and my shorter duration cash flows from the bond market. I think that's how you're allocated, and if the Fed does the right thing, they'll push back on it still, but they're going to ease. I think 3 times is my call, and the market, I think, will react positively to it for a little while longer.
A lot of Fed speak and
Well, that was a mouthful. But didn't they? I'm not 100% sure. I heard, or heard somebody talking about, what's her name? Jean-Pierre, the White House spokesperson. Who's that? Peter Ducey that's always challenging her. I think he mentioned that they possibly have changed the definition of a recession, which normally should have been 2 quarters of decline in growth would be considered a recession status, I believe. But I don't know. I don't know. It just made me think of that for a second. But yeah, let me know what y'all think about this article, man. I've seen a TikTok video of a lady speaking about the feds, but I'll go over that at a later date. Down Home News TV.